If you're a business owner, there might be a $50,000 threshold in your corporation that you probably don't even know about. But if your investments cross it, you could be handing over the CRA thousands of dollars in tax you didn't need to pay. Here's what the passive income trap actually is and why many business owners don't know about it until it's too late. In the next few minutes, you'll understand what the small business deduction rate is and why it's the most valuable tax break available to Canadian business owners. And I'll walk you through a case study of a business owner who had $3 million investment portfolio inside her corporation and was paying about $85,000 in tax per year that she didn't even know about. I'm Quentin Chambers, a financial planner and portfolio manager. I build total wealth plans and manage portfolios for business owners, incorporated professionals, and affluent Canadians. And after more than a decade of doing this work, one thing is clear. People are leaving serious money on the table. And on this channel, I show you where to look. Okay, so let's start with the setup. You're a business owner or you're an incorporated professional, and every year you're earning income. First $500,000 of income is taxed at a low rate called the small business rate. In many provinces, that's around 9 to 10%. Now over time, maybe you've been in business or running your practice for 5, 10, or 15 years, and you've been running an annual profit, and you've started to accumulate what's called retained earnings. Retained earnings is money that's left over after you've paid over necessary business expenses, paid yourself, and your corporate taxes. You start looking at the money sitting in your business savings account and you think, I should invest this. I should make sure this money is working for me. So you do. You buy some GICs, you buy some dividend paying stocks, and maybe a fund or two. But here's a trap. Many business owners don't realize that the gains from their investment portfolio is impacted by a limit called the passive income limit. The passive income inside your corporation is treated completely different by the tax system. When your corporation has more than $50,000 in annual passive income, your small business deduction begins to be impacted. So how this works is on a sliding scale. Your small business rate is reduced by $5 for every dollar of passive income you receive above the $50,000 limit. So what this means is if you receive $60,000 in passive income or $10,000 above where that passive income limit starts, your small business limit is reduced by $50,000. If you hit the max of $150,000 of passive income, your small business rate is completely eliminated. And here's the part that really gets business owners. This is a part that nobody explains until it's too late. You don't lose your small business rate on your passive investment income, you lose it on your active business income. That's the cruel part. So let me quickly explain the policy reasons so you understand why this exists. The government created the small business rate to help small business owners grow. 9 or 10% corporate tax is way lower than your personal marginal tax rate. The whole idea is to encourage entrepreneurs to reinvest in their business. But the government also said, we don't want to use this rate as a tax sheltering strategy for passive income. So if you have $1 million sitting in your corporation earning investment income, that's not really active business income in the traditional sense. That's normally wealth accumulation. So what they said is, if your passive income gets too high, you lose a small business rate on your active business income. And the real impact is if you're losing your small business rate, meaning on your first $500,000, you're not taxed at the 9 or 10%, you're going up to 20 or 30%. So obviously the jump from 9% to 27% is massive. That's about an 18-point swing. And that's why even on $400,000 of business income, that's roughly $72,000 in additional annual tax. And I've seen it where many business owners have no idea they're in this zone until their accountant mentions it in passing, usually years after this problem has already started. Which brings us to the expensive realization and how to prevent it. Now, there are several ways to manage passive income so you don't lose your entire small business rate. The first is going to be understanding how the different types of investment income are taxed. First is interest income, money from bonds, GICs, savings accounts. That's all passive income in the eyes of the CRA and it is fully taxable. Then we have capital gains or eligible dividends from Canadian corporations, which are also passive income, but they do receive preferential tax treatment. So the first strategy relative to this is to be deliberate about your investment holdings. Instead of holding interest-bearing investments inside of your corporations, focus on capital gains generating investments because of that preferential tax treatment. In this case, you're looking for equity funds, growth stocks, index funds, things that produce capital appreciation rather than annual income. Now, capital gains are still passive income from a tax perspective, but because they're not actually triggered until you sell off that investment, it allows you to defer that taxable event. I should also be clear, in this case, your time horizon, meaning when you're actually going to use that money, and ultimately your risk tolerance is also going to be a factor, but that should be weighed off in terms of the cost benefit of which products you hold in your investment account. By holding investments that generate capital gains can help you stay below that $50,000 threshold for longer. The second strategy is corporate class funds or ETF swaps. These are products that are specifically structured for tax efficiency. Instead of distributing annual income like most investment products, which trigger passive income, they reinvest the earnings inside the funds, creating a capital gain. And again, in this case, the capital gain isn't actually triggered until you sell the funds. It has the same economic result, but the timing of the taxable event is completely different. Okay, and then we have the third strategy, and this is where things get a little more sophisticated, and this strategy should be used in the broader context of your overall wealth plan. The strategy is using a participating whole life insurance to absorb your retained earnings. How it works is the corporation buys a policy under the owner's life, funded with retained earnings. The policy grows tax sheltered and no passive income is triggered. The death benefit eventually flows through your corporation to your estate through the capital dividend account, which is again completely tax-free. This strategy serves two benefits. It allows you to redirect your money to a tax sheltered product without generating any passive income, as well as creating an estate planning tool. Now here's the part that is missed far too often. Any strategy is only good with the benefit of context. You need to know how it applies to your specific situation. Now, I'll walk you through a real case study to make this a little more tangible. I recently had a new client who was a veterinarian in Saskatchewan. She'd been running her practice for about 15 years and she'd been quite successful. Over those 15 years, she'd accumulated about $3 million in investment assets inside her professional corporation. She had this sitting in a fairly traditional portfolio. Lots of bonds, some dividend stocks, and a variety of different mutual funds. And when she came to us, we did a full review. I flagged a serious issue. Her annual investment income from the interest in her bonds, dividends, the whole mix was running about $150,000 per year. She hit that passive income ceiling. And here's what that means. The federal clawback rules on the small business rate operate on a sliding scale starting at that $50,000 of passive income. At $150,000, that clawback was complete. Her entire $500,000 small business deduction limit was completely gone. Every dollar of active income in her veterinary practice was now being taxed at the general corporate rate instead of having the benefit of the preferential small business rate. On that first $500,000 of active income, that's about $85,000 in additional tax every year. She had no idea. So here's how we restructured. First, we repositioned our portfolio towards capital gains generating investments and away from interest income. We also used corporate class funds where it made sense to defer income recognition inside of our corporation. It took us about 18 months of deliberate restructuring, planned closely with our accountant to make sure we weren't creating unintended consequences. We got that passive income inside of our operating corporation back below the $50,000 threshold. Once that happened, she retained the full small business rate. The result was $85,000 in annual tax savings on her active business income going forward. Now, that's not a one-time fix. With proactive management, we can keep her under that passive income limit. So that's an $85,000 annual benefit. Over a decade, that's $850,000. And she didn't have to change her business, her lifestyle, just the way her investments were held. Now, this insight is more than investments because everybody's situation is going to be different and how you achieve this is going to be relative to your specific situation. So what should you do next? If you've been accumulating retained earnings in your corporation for more than 5 years, this is a conversation worth having. Many business owners don't know if they're in that passive income clawback zone or not. I've seen it where your accountant knows, but you might not. The first step is simply asking, am I generating more than $50,000 in annual passive income? If the answer is yes, you need to understand the cost because that small business rate is so powerful. Once you know the numbers, you can decide if restructuring makes sense. In many cases, if you've accumulated significant assets, the answer is going to be yes. The tax savings are substantial enough to justify some strategic restructuring. Now, this is not a DIY project. You need both your accountant and your wealth advisor working together. Your accountant is going to understand your corporate structure and can run the numbers, and your advisor is going to help ensure that you have the right investment strategy in whatever structure you settle on. So if you're a business owner or an incorporated professional earning over $250,000 in your corporation, download my Business Owner Playbook. It's a short checklist of planning levers that quietly decide whether your corporation is working for you so you can confirm that each one is pulling its weight. Most business owners or incorporated professionals who run through it spot at least one area where they can keep more of what they built and walk away knowing that your setup is working for you. The link is in the description. If this video is useful, hit the like button or drop a comment and let me know what topic you'd like me to break down next. As always, please subscribe so you make sure you get videos just like this in your feed. Until the next one, take care.